All right, ladies and gentlemen, I hope you had a wonderful day. It was a lot different in the markets today than the last couple of days. We saw NVIDIA rally instead of getting beaten down. The rest of the Mag 7 went up, and then the equal weight got absolutely demolished. So we had some data and a couple of other things. There was even some big news after the bell. Rivian is up 70% on news that they are doing a joint venture with Volkswagen and got a $1 billion investment. And then FedEx, they killed it and they moved up 15%. I don't even think they've moved that big in the last 12 months. You remember that 1,000%er we had on FedEx? Well, this move is double that size. So that's going to be interesting. We have a lot of other things to talk about, but I'm going to do what we did yesterday, and we are going to start with the question of the day and talk about the difference between a hard landing, a soft landing, and a no landing. So if you have been watching the watch list, we have been talking about this theme to start the week because with everything going on, everybody has been focused on this hard landing because the data really hasn't been moving. If anything, actually, no, they're focusing on the soft landing. And what we were talking about on Monday is that the first time in a long time, the odds and probability of a hard landing are the lowest they have been, and the probability of a no landing, it is creeping up, and that has been a trend that you have witnessed all of 2024. So what is the difference? What does this all mean? We have talked about this before. Some of you are aware of it, but to give you a refresher, the landing that everybody is talking about is in reference to inflation and the economy. Inflation can come down in a few ways, but when it does that, it comes with a few consequences. If inflation comes down and does not slow the economy, that is considered the no landing scenario. This is the best case scenario that everybody is expecting. If inflation comes down and causes a couple of economic hiccups and small economic declines, that would be the soft landing, no major pullback in the economy. And then a hard landing is if inflation comes down and the economy comes down with it. So right now, the base case, the majority of what everybody's expecting to happen is that we get a soft landing. Inflation comes down, the economy pulls back slightly, but nothing major. But it's not like you keep going and the economy doesn't react to inflation coming down. That is the base case. The best case would be inflation disappears, the economy doesn't get affected, and you resume economic output and growth, and everybody is all smiling and roses and skipping. Do people skip still? I don't know. I feel like that's something Trump would say. Are they skipping? But finally, the worst case scenario would be a hard landing. Inflation comes down. That's something everybody's wanted to see, but it does so as a consequence of the economy suffering a recession or having a major pullback. So that is the simple answer to all of this, and this is why all of the data and how we've moved in that path that we've been talking about, this is why it's so key, because right now, people are believing the base case is a soft landing, but like we talked about with AI and the data and Powell and everything, 2024 has been the year of the narrative being that a no landing is possible, and now it's more probable than it has been at any other time. So hopefully that gave you a little bit of insight. But now, Chad Adonia, what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning, baby. Run it.
Couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, before I get to show you the chart, because you'll see it a little bit on the market, we have to talk about the market breadth once again and the type of reaction that it is creating. So if you look today, the NASDAQ went up 1.26%, the Dow and Russell went down, and the SPY went green. But believe it or not, the S&P had over 300 names negative. The NASDAQ actually had a lot of advancers, and what you got today. It looks like it was a green day and the market didn't do much, but it was the opposite of the last couple of days. In the last couple of days, what do we see? Every other name going up, while Nvidia, Apple, and Amazon, they kind of chilled and found that balance and everything rallied. Well, today it was the rest of the market dumping while Nvidia recovered. They even went up 6%. So remember, we were talking about Nvidia having this 3-day decline. In the last 3 days, they lost $450 billion in market cap. Well, after today, they kind of cut that in half here. So what you got today was everything dumping, and the big tech, Apple, Amazon, Microsoft, they had their move. So this low liquidity, high concentration, and the market breadth, it was in full effect today. It's just a couple days it's in one area, it's the 493 and then the 7 decline, and now today the 7 rise and the 493 decline. So that was the first part of the day, but the second part, it had to do with the data, and this is where things are getting interesting. Once again, does it mean you'll have to get a reaction? No, unfortunately. This is why I keep mentioning the path, and we're starting talking about hard landing and soft landing and all of that, because you got to think about it. If you take the 50-60% odds of soft landing and then add that to the 23-30% odds of no landing, that means it's a 90% probability so far. This could always change, but the market is expecting a no landing or a soft landing scenario. They are not worried about data or anything like that. So we did have real estate prices go up today. There was more collapsing in manufacturing and service data. I think even the surprise index is hitting one of its lowest points, even below 2022 and 2023. Like I've told you, a lot of the other names, if you ignore the 7, some individual stocks are absolutely dumping right now. You have a big amount of names that are trading below their 50-day moving average, but even the economic data is full-blown collapsing. But the bonds are holding up. You're not getting a reaction on equity, and that is because people are waiting for something bigger to really move, because they believe we are still riding this path. And if anything, they're just focused on the finish line rather than the noises and anything else that's happening until or if there will be an external shock. So that's a big part of what we got today. I think it kind of sums up a lot of these reactions, and you're going to get a lot more of this. So if you're not prepared for summer trading and how it is, unless we get an external shock, I wouldn't be surprised for this to keep happening. And the market is already looking ahead. This is about to be the last week of June. July has been one of the most bullish months. People are already talking about it. They are getting excited. And to give you context, the last time we had a negative July, it was 10 years ago in 2014. That means 2015, 16, 17, 18, 19, 20, 21, and 22 were all green months in July. So that's where we're setting up into, and then that'll be the end of the buyback blackouts and all of that. So keep this in mind. We'll keep monitoring how all of it plays forward, and that even kind of leads into the next key, because we are getting these reactions and how the market moved. I'll show you on the chart. You got to watch out for that Powell level, but now with how things are playing out, we'll be looking for that PCE on Friday. That's really the only thing I'll be watching. There was a bond auction today, and that came in decent, but the market liked it. Tomorrow, you will be getting a 5-year auction, and then 7-year. That's going to happen on Thursday, but even then, I don't think the auctions are really going to be that big of a deal. When they were sensitive and the market was more sensitive to data in the path, yeah, those auctions were very disruptive, but until Powell or Yellen starts talking about more money and making bigger changes, or I don't know, maybe where's Moody's and all those guys, I really wouldn't be worried too much about it. So keep your eyes out for the data on Friday. That's still going to be the main event. Otherwise, now, I would keep an eye out for price action. So this is something that we talked about today, and you actually saw it react almost perfectly, but don't forget, it was about, 2 Wednesdays ago? Man, I got to pull this chart out even more. Yeah, right here, this was the Powell level. You even see where we bounced off of today. It was into the high of Powell. We went a little bit lower, and then you bounced right off of it. But it was the first time now in a couple of days or a couple of weeks that we came back to that Fed level. But this is why I think it's interesting, because depending on how the data plays out, we're either going to be holding above that, and by the time we get PC and everything else, you're going to be far removed from Powell. Or if the data is bad and we don't want to really rip past 5,500, this little zone of top of Powell to bottom of Powell, even that gap fill from that positive CPI. Remember, Powell Day had a good CPI. This would be a range, and just look out for the openings and closings and the highs and lows of those days to give you some levels, but that's what I'd be watching out for. Other than that, though, if the market doesn't want to naturally move or the PCE doesn't give us much, pay attention to those earnings. And today, after the bell with FedEx, we already got a little bit of a sample of that. So watch out for that. That is key number 2. And then finally, the earnings moves have been pretty decent so far. So, yeah, we're following the path. Things are going to move slow in summer. You got to be cautious about that. But for now, these earnings moves have been good. CCL, even SEDG, and earnings guidance. If it's bad, the companies have been clapped. If they did good, they've been getting rewarded. So for now, things are looking good, but it's hard to tell if it is just this low liquidity summer environment. Otherwise, if things are going to be good throughout the summer and the earnings and seasonality all playing good, you don't really have to fight this, and I would ride the wave. But here's the deal. As we are dealing with low liquidity, I think this is a good time to remind you. And low liquidity, lower volume in summer, I'm here to tell you not to get punched in the face. The goal of any market, not just the stock market, any market you could think of, the goal is to punch speculators in the face. And what that means is if you're going to make an action and you really want to make a move, make sure you have an intrinsic reason of why you are doing it. If you're like, oh, I'm just going to buy it and sell it to the next guy, well, that's the greater fool theory. But in low liquidity, where small movements can cause big changes and then it could chill out for a long time and then pop or drop out of nowhere, that's not really going to be the best environment. You really got to make up your mind. So you could do plays with conviction, and if you actually have the conviction and follow through with it, you will be rewarded. So watch out for all of that stuff. Keep all of this in mind. But now, let us get into the plays. So, right off the bat, I got a couple of different plays. Some of them might sound familiar, and one of them is a play that I made today, and I'm going to talk about how to apply this to the other two, but let's start with the first one, FedEx. I got the play on this one yesterday. We had the 295s and then the 300. I sold out the 295 because it didn't have time, but that 300 just above the 2 standard deviations, this one might end up hitting, and we've got a good price on it, so this will be awesome. I have a play. I have exposure. I am biased. Thankfully, I kept it very small, so it's not like it's too crazy of a bias there, $70, but I am looking for a continuation above $300 tomorrow. I think there will be a lot of upside because if you remember that other FedEx that we hit, it was around these levels, but prior to that earnings, it was trying to get to the 300 and then failed. But now, after 2 of these earnings, it already even rallied up there not too long ago. It's gone back up to this level. If that holds around those 300s, this thing was at like 320, 330, so it does leave some upside, and this has been the biggest FedEx move in over a year. So if this holds tomorrow above 300, the conference call doesn't go down, the pre-market moves, and the analysts allow this thing to get up there, this should be a good continuation. And we'll talk about how you could play that if you didn't get a play, but I'm going to be writing out my plays. Otherwise, though, if it stays at 295, this thing might sell off. Again, we did hit a FedEx really good at the beginning or end of last year. That's what started off our train of 1,000%ers on the 2 standard deviations. Well, I remember that morning we profited on some of them, but some of them, they and just quickly out the window. So, yeah, earnings trauma. You got to be careful for that. So watch out for that, though. That is going to be play number 1. Then play number 2 in the same breath. I brought up all these plays yesterday. A lot of people were asking me, what you play? I sent them here to the watch list. So Nike, go to yesterday's watch list, but you're here right now. I will tell you, I made a play on this both ways. I went with next week, I believe, an 84 contract or 85 put, 2 of them in a 110 call. I grabbed 2 of them, and the idea was to sell out before earnings. And now today the calls got killed. The puts went up a little bit, but I like this earnings. I think 2 standard deviations could be interesting because so far it's the early season here with these earnings names. And like I'm telling you, we've seen some decent moves. So Nike, they're in the middle of recovery or failing their recovery. I think 2 standard deviations could do a lot. And it's one of those value plays in an interesting industry. It's not like it's the mega cap 7. So we'll see where this one goes, but those are the plays I'm holding. I am going to be riding this one out. If anything, I'll trim 1 contract on both sides tomorrow. Otherwise, I do plan to hold this, and I think Nike, there's a lot in store for this earnings. If not, though, if you disagree, I'd sell the premium because those premiums are decent. And if it doesn't do anything, then womp, womp, womp. Or don't forget, too, these plays that I'm doing, I'm on 2 standard deviations. So if you go and see how the options are priced, if you think it'll move but not move outside or extraordinary of what's pricing in, you'll have a better chance making money on a closer to the money than going after these further out the monies that we have been playing. So keep that in mind. That is play number 2. And then finally, play number 3. This one might be the answer to everything, believe it or not, but CCL. So I went for a continuation today. We'll talk about that here in a second, but I would watch out for what happened on this stock for all the other earnings. So you still will need the stock to do good. You could get pump faked a lot, but to start off earnings season here, make sure you guys always remember the Frogger, or the fact is a company can report, and even though it'll move like 4 or 5%, the options won't always go up because of what they were pricing in ahead of time. And that's what happened with CCL today. They had their earnings, they killed it, and the stock was up like 5-6%, came back down a little bit. It was still up like 4%, and I saw the options were going cheaper than where they were at the day before after getting the earnings, after beating, and after trading higher. So they had their conference call starting. I said, hey, if this continues and they do good, these will be a cheap play. We grabbed a small one, and that ended up working. So why I'm telling you this, well, tomorrow, Nike, you're going to have to play before the event, but tomorrow morning with FedEx, this is definitely something that I would be looking out for. So watch out for that. That is play number 3. And now to the plays of the day. The only play that I made was that CCL, so I grabbed it next week, July 5th, CCL 18.5 call. Only grabbed one, $16. I even talked about this, although I didn't share the play. I told you guys I went into a CCL, but I was saying, these options look kind of froggy. We were talking about it, and I waited. It came down, decided to do it, but kept it small because, like I'm saying here, I don't like this environment as much. I got my cash. I'm waiting for something bigger, and I want more volatility, so I'm going to keep my very small plays, and hopefully, though, we don't get too many quantity of small plays because that could still add up, but this one ended up working. They went about like 40 to 70%, so still riding that out. We'll see where that plays out tomorrow, and then if we could do this on the FedEx, but that is all that I have for you. We already went over the questions, and now for the lesson of the day, we are going to continue into the import substitution and talk about the types. And yesterday, we were talking about why we got into the, the structuralist arguments and industrialization, how these developing countries develop certain ideas, what got them to believe it. And now we're going to talk about the different types of import substitution and how we developed from there. So good work, Chattadonian. Remember, anytime I interrupt, it's opinion. If you have any questions, let me know. And don't forget, we have a full playlist. I still got to update it here, but if you are behind, we've gone over 130 or 40 pages now in this book, International Political Economy by Thomas Oatley. We are making a lot of moves on it, so if you want to catch up with it, you are going to have to go through on your own time. But now, let us get into the lesson, baby. Domestic and international elements of trade and development strategies. Structuralism enabled governments to transform the protectionist trade policies that benefited their principal political supporters into comprehensive state-led development strategies. The trade and development policies that most governments adopted following World War II had both a domestic and an international dimension. At home, the desire to promote rapid industrialization led governments to adopt state-led development strategies that were sheltered by high protectionist barriers. In the international arena, concern about the distributional implications of international trade led developing countries to seek far-reaching changes to the gap-based trade system. We examine each dimension in turn. So, like we said, they all had their ideas there, and some were worried, and then they advocated for changes. What did they advocate for? So, import substitution industrialization. Structuralism provided the intellectual justification for a state-led development strategy. Confidence that the state could achieve what markets would not was based in part on evidence of the dramatic industrialization that the Soviet Union had achieved between 1930 and 1950 with an approach based on centralized planning and state ownership of industry. In developing societies outside the Soviet bloc, the state-centered approach to development came to be called import substitution industrialization, or or ISI. The strategy of ISI was based on a simple logic. Countries would industrialize by substituting domestically produced goods for manufactured items that they had previously imported. Governments conceptualized ISI as a two-stage strategy. Its initial stage was wholly a matter of imitation and importation of tried and tested procedures. Easy ISI, as this first stage was often called, focused on developing domestic manufacturing of relatively simple consumer goods such as soda, beer, apparel, shoes, and furniture. The rationale behind the focus on simpler consumer goods was threefold. First, there was a large domestic demand currently satisfied by imports. Second, because these items were mature products, the technology and machines necessary to produce them could be acquired easily from advanced industrialized countries. And third, the production of relatively simple consumer goods relies heavily on low-skilled labor, allowing developing countries to draw their populations into manufacturing activities without making large investments to upgrade their skills. So hopefully you're getting it so far. Import substitution, they're saying, hey, yeah, we used to import this stuff, but instead let's industrialize, make a market, so then we could just create the stuff that we were importing. And then the first place they started, the Easy ISI, it was stuff that was already there. Think about the Coca-Colas or the sodas that existed in basic stuff. They're like, well, we don't need the workers as much. There's already a demand for it, and we could get the machinery easy. That's what literally made it Easy ISI. So that's the first part. Continuing. Governments are expected to realize two broad benefits from Easy ISI. Initially, the expansion of manufacturing activities would increase wage-based employment as underutilized labor was drawn out of agriculture and into manufacturing. In addition, the experience gained in these manufacturing industries would allow domestic workers to develop skills collectively referred to as general human capital that could be applied subsequently to other manufacturing business. Of particular importance were the management and entrepreneurial skills that would be gained by people who worked in and manage the manufacturing enterprises established in this stage. Success in the easy stage would therefore create many of the ingredients necessary to make the transition to the second stage of ISI. So this one's pretty cool. They're saying, hey, not only can we take all the people from agriculture, or if we have underutilization of labor, we now can give them something to work. And then remember the structuralist problem. They're like, well, who's going to buy this stuff? They're saying we're going to start with the stuff that already has demand. Now we could employ the people. And then on top of it, the cool part, they're like, well, yeah, once they learn how to both work in factories and then the business around making them and becoming an entrepreneur around them, that could lead into the next stage of development. So pretty cool to think about. Remember, this is for the developing countries. So Easy ISI would eventually cease to bear fruit. No, the domestic market's capacity to absorb simple consumer goods would be exhausted, and the range of goods that could be produced would be limited. At some point, therefore, governments would need to shift from Easy ISI to a second stage strategy characterized by the development of more complex manufacturing activities. One possibility would be a shift to what some have called an export substitution strategy, in which labor-intensive manufactured good industries developed in Easy ISI begin to export rather than continue to produce exclusively for the domestic market. Many East Asian governments adopted this approach, as we shall see in Chapter 7. So it's saying eventually you're going to run out of opportunities to keep growing, you're going to exhaust the market, and then you kind of see this in your daily life like the East Asian countries have done. They started with Easy ISI and producing for themselves, and then they're like, well, damn, now we could just export it and sell it to other countries as we've developed, got better, and we're utilizing our labor force at a very productive rate. It makes more sense to export, but we'll talk about that. The second alternative, and the second one adopted by most governments outside of East Asia, was secondary ISI. A secondary ISI emphasized shifts from the manufacture of simple consumer goods to consumer durable goods, intermediate inputs, and the capital goods needed to produce consumer durables. In Argentina, Brazil, and Chile, for example, governments decided to promote domestic automobile production as a central component of secondary ISI. Each country imported cars in pieces called complete knockdowns and assembled the pieces into a car for sale in the domestic market. Domestic auto firms were required to gradually increase the percentage of locally produced parts used in these cars that they assembled. In Chile, for example, 27% of a locally produced car component had to be manufactured domestically in 1964. The percentage rose to 32% in 65 and then to 45% in 1966. So this is something I'm going to ask you, does this exist today? If so, how much? Think about that. Knockdowns and cars and pieces and then assembling them. By increasing the percentage of local components of cars and other goods in this manner, governments hope to promote the development of backward linkages through the economy. Backward linkages arise when the production of one good, such as a car, increases demand in industries that supply components for that good. Thus, increasing the percentage of locally produced components of cars by increasing the demand for individual car parts would increase domestic part production. The latter would, in turn, increase demand for inputs into part production, steel, glass, and rubber, for example. Industrialization, therefore, would spread backwards from final goods to intermediate inputs to capital goods as backward linkage multiplied. So this one, it's same thing but a little different, but you're working backwards, expanding. It's not always like, the items that already had demand and all that, but they focused on increasing demand of certain items that required a lot of things from parts to capital. And then the general idea was, hey, if you require people to do this, and all of this stuff, essentially, they're going to have to make more car parts, more gasoline, or more glass, steel, rubber, all of that. And then if you need more of that, it's going to create more factories. And if you need more factories, people are like, yeah, we can make money. That's going to spur the capital as well. So continuing, governments promoted secondary ISI with 3 policy instruments: government planning, investment policy, and trade barriers. Most governments structured their efforts around 5-year plans. Planning was used to determine which industries would be targeted for development and which would not, to figure out how much should be invested in a particular industry, and to evaluate how much investment in one industry would influence the rest of the economy. India's second 5-year plan, for example, sought to generate ambitious growth in manufacturing by targeting the development of capital goods production. The plan thus served as coordination device that governments thought necessary given their belief that the market itself could not coordinate investment decisions. With a plan in place, governments used investment policies to promote targeted industries. Most governments either nationalized or heavily controlled the financial sector in order to direct financial resources to target industries. Governments also invested directly in those economic activities in which they thought the private sector would not invest. Much of the infrastructure necessary for industrialization, things such as roads and other transportation networks, electricity, and telecoms, it was argued, would not be created by the private sector. In addition, the private sector lacked access to large sums of financial support needed to make huge investments in a steel or auto plant. Moreover, it was claimed that private sector actors lacked the technical sophistication required for large-scale industrial activity involved in secondary ISI. So hopefully this makes sense. They're like, yeah, we could do these factories, do this backward working thing, but the problem was, a lot went into it and the market wasn't willing to do it. Investors wouldn't. That's why, government planning and all of that was necessary. This is what pretty much leads you to the whole state-owned model and then import substitution, state-owned. That's why I started with some of that Soviet stuff. But continuing, governments invested in these industries by creating state-owned and mixed ownership enterprises. In Brazil, for example, state-owned enterprises controlled more than 50% of total productive assets in the chemical, telecom, electricity, and railway industries, and slightly more than 1/3 of all productive assets in metal fabrication. Indian state-owned enterprises provided 27% of total employment and 62% of all productive capital. In Africa, governments in Ghana, Mozambique, Nigeria, and Tanzania each created more than 300 state-owned enterprises, and in many African countries, state-owned enterprises accounted for 20% of total wage-based employment. Throughout developing societies, therefore, the shift to secondary ISI was accompanied by the emergence of the state as a principal and, in many instances, the largest owner of productive capacity. Finally, governments used trade barriers to control foreign exchange and protect infant industries. Because export earnings were limited, governments controlled foreign trade to ensure that foreign exchange supported their development objectives. After all, many elements critical to industrialization, including intermediate inputs and capital goods, had to be imported. Protection also allowed infant industries to gain the experience needed to compete against established producers. In Brazil and India, for instance, the state prohibited imports of any good for which there was a domestic substitute, regardless of price and quality differences. The scale and structure of protection that governments use to promote industrialization are illustrated in Table 6.4, which focuses on Latin America in the 60s. In all but 2 of the listed countries, nominal protection on non-durable consumer goods was well over 100%, and for all but 3 countries, tariffs on consumer durables also were over 100%. Mexico and Uruguay stand out as clear exceptions to this pattern, which has more to do with the country's extensive use of import quotas in place of tariffs rather than an unwillingness to protect domestic producers. It is also clear that tariffs were lower for semi-manufactured goods, industrial raw materials, and capital goods, all of which were items that developing countries needed to import in connection with industrialization than they were for the consumer goods. This pattern of tariff escalation was common in much of the developing world. The cost of ISI was borne by agriculture. Governments taxed agriculture exports through marketing boards and controlled the purchase and export of agriculture commodities. Often established as the sole entity with the legal right to purchase, transport, and export agriculture products, marketing boards set the price that farmers receive for their crops. In the typical arrangement, the marketing board would purchase crops from domestic farmers at prices well below the world price and then would sell the commodities in the world market at the world price. The difference between the price paid to domestic farmers and the world price represented a tax on agriculture incomes that the state could use to finance industrial projects. The trade barriers that protected domestic manufacturing firms from foreign competition. So again, it's saying how they went about these industrialization processes. And again, agriculture was the winner, but I mean, it kind of led to the system style you have today with both the subsidies and how we play things out. I mean, nowadays we support the farmers more, but you got to think about it in that sense when it was the leader. So again, they also taxed agriculture. Tariffs and quantitative restrictions raised the domestic price of manufactured goods well above the world price. People employed in the agriculture sector who consumed these manufactured goods therefore paid more for them than they would in the absence of tariffs and quantitative restrictions. Such government policies transferred income from rural agriculture to urban manufactured and non-traded goods sectors. The size of the income transfers was substantial, as a World Bank study summarized. The total impact of interventions on relative prices between agriculture and manufacturing was in some countries very large. In Ghana, farmers received only about 40% of what they would have received under free trade. Stated in another way, the real incomes of farmers would have increased by 2.5 times had farmers been able to buy and sell under free trade prices given the commodities they in fact produced. While Ghanaian total discrimination against agriculture was huge, Argentina, Cote d'Ivoire, the Dominican Republic, Egypt, Pakistan, Sri Lanka, Thailand, and Zambia also had total discrimination against agriculture in excess of 33%, implying that in all those cases, farm incomes in real terms could have been increased by more than 50% by the removal of these interventions. So if you're not getting what it's saying, there was a cost to bring about this manufacturing, to get this import substitution and industrialization. To do that, they literally, these countries that had these big agriculture sectors, they all had to pay for it. So even and y'all wonder why I'm like, yeah, some ideas are good, but when they execute it, it did eventually lead for benefits for all. But you could see at some point, I mean, imagine how painful it would have been for these countries. And ironically, these were the same countries, and they're like, yo, man, we don't trust y'all with trade. We're disadvantaged. And then, they started getting better imports and other benefits and utilizing labor that wasn't used, but then they have to pay a certain cost to their agriculture businesses. So I guess a game of winners and losers. But continuing, thus ISI redistributed income. The incomes of export-oriented producers fell, while those of import-competing producers rose. The strategy of ISI promoted rapid economic growth in the late 60s and 70s. Developing countries' economies grew at an annual average rate of between 6 and 7.6% during this period. In many countries, it was the manufacturing sector that drove economic growth. Argentina, Brazil, Chile, Mexico, Mozambique, Nigeria, Pakistan, and India, to select only a few. A few examples all enjoyed annual rates of manufacturing growth between 5 and 10% between the 60s. During the 60s, a glimpse back at Table 6.1 indicates that in Latin America, manufacturing share of total economy increased substantially between 1960 and 1980. Although the policies that the governments adopted had important effects on the distribution of income, they also appear to be transforming developing societies into industrialized economies. So, nice little history lesson with all of it. And now, hopefully you understand import substitution, a little bit of the challenges and how it ended up playing out. So, Chatadonia, I hope you're learning with me, but that is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, you got to hope for bigger and better things. That's what gets you motivated. If you ain't looking for bigger, why are you even getting up in the morning? But if you do, it'll motivate you, baby. But Chad, I love you all. Drink that water. Stay hydrated, healthy. I'll see you in the morning. And horn.